Good morning, bro, and welcome back to the new stock evaluation video. Today we are going to analyze this extremely famous dividend company called Waste Management Incorporated with the stock ticker VM. Now, as always, we are going to analyze it using this little Canva presentation that I prepared right now here. So let's begin, okay? First of all, why should you even listen to me? My name is Yasha and I am your best stock analyst who will help you make smart decisions on the stock market. Now, this is me right now here. And additionally, when you will start to trust me a bit more, you can click the first link in the description where I will teach you how to properly analyze stocks so that you can become like your own stockbroker, so to say. Now, let's begin with the actual analysis. So this is going to be very simple, straightforward and beginner friendly because I don't want to use too much of your time and waste your time, most importantly. So let's begin, okay? Now, generally, as a complete beginner, you should care about the following 6 things: chart, profit, debt, money on the bank account, value, and price. Now, Waste Management, bro, is a company that takes rubbish. I didn't know how to explain that properly, but it was founded in 1987 and it's operating in USA and Canada. So me as an European, I don't know anything about this at all. Only I know that they pay dividends and they are quite a good dividend company. Now, let's begin with the actual analysis, bro, a bit of jokes aside, okay? Now, we will begin with the chart, okay? And for chart, we have here a little instruction that tells us chart has to grow for all 10 years that we analyze. Now, what exactly does that mean? That means that first of all, I will draw a little exponential growth line, kind of like this. And then we are going to compare the actual stock price, which is this orange line, with that black line. And preferably, they should follow each other. Now you can see here, bro, that those two lines are completely in sync, you know, like the orange line, which is the stock price chart, follows this exponential growth quite good, you know, it goes up and a bit down, up, but generally up, you know, so that's a good thing to see, okay? Now we come to the profit, and for profit we also have instruction that tells us profit has to be in plus and it has to grow through the years. Now here is the very same story, bro. I will draw a little exponential growth line, kind of like this. And then we are going to compare the profit chart with this line. So you can see that first it started to go a bit down and then up and then down and up. But generally it has that upward strength, what we want to see. So profit is also a good thing to see, okay? Now we come to the debt, and the instruction tells us that debt has to be low and preferably it should also decrease through the years. Now here we obviously want to see debt going kind of like that, you know, like the black line. But here we have quite the opposite, bro, because the debt is growing through the years. So that's a not very good thing to see, okay? Because we want to see debt low and it to decrease. Now we come to the money, and with the money, I mean money on their bank account. How much they literally have on their bank account that they can withdraw at any given time, okay? And preferably they should also have more money than costs. Now, do they have more money than costs? Bro, use your fucking brain. Look, here they have plus $2.1 billion on their bank account, so that they can literally right now withdraw $2 billion. That means, bro, that obviously they have more money than the costs. Otherwise, their bank account would be in minus. It's that simple. Now, that's also good to go. Now we come to the value, and bro, we as dividend investors or overall investors, we want to invest in stocks that are undervalued, okay? We want to invest in stocks that have those nice bargains. How do we measure valuation? With two little measurements, so to say. One is P/E ratio and the other one is called intrinsic value. Now, as a complete beginner, bro, those two concepts might sound a bit strange to you, but trust me, just follow this rule of thumb, which tells you P/E ratio should be lower than 15 in all of the stocks, and intrinsic value should be higher than the current stock price. Now, you can find P/E ratio and intrinsic value for Waste Management on the internet. Just literally open Google and write P/E ratio Waste Management or intrinsic value Waste Management, and you will find the numbers, okay? Now, current P/E ratio for Waste Management is 34, around 34. So it's actually double the size of, double the value of the P2 ratio that we want to see. So in terms of P2 ratio, bro, Waste Management is a bit overvalued. Now we come to the intrinsic value, and here I want to have your full attention because this is very important concept, okay? Intrinsic value tells you the price that the company should have at this exact moment based on some calculations from, I don't know, income statement, balance sheet, and cash flow statement, okay? Now, based on those calculations, the fair price, the price that Waste Management should have at this exact moment is $165. But currently, the price is around $209. So it's around 40 or let's say $45 higher than it should have been. You know what I mean? Because intrinsic value should be higher than the current price in order for stock to be undervalued. But here, intrinsic value is lower than the current price, so stock is overvalued. It's that simple, okay? This basically tells you the price that it should have, and this is the current price. It's that simple. So stock is overvalued. And now we come to the price, and our instruction tells us that price has to be lower than 150 euros or dollars or British pounds, wherever you are from, bro. And currently the stock price is sitting at $209, a bit more. So it is lower than $150. So it is overpriced as well. Now, $150 is kind of the border that I decided for myself between overpriced stocks and underpriced stocks, because I personally don't want to invest in stocks that are too expensive, because what does it bring you that you are investing in some, I don't know, Microsoft stock or something that costs $400 and then it goes up only, let's say, $20 and you get only 1 cent out of that? That doesn't make sense at all, bro, at least to me. Now we come to the final evaluation, bro, where we are just going to summarize everything that we found so far about this company, okay? Now, does chart grow exponentially? Yes, it does. If you don't believe me, revert a few minutes and you will see the analysis, okay? Now, does profit grow as well? Yes, it does. Now, does debt decrease through the years? No, it unfortunately doesn't. Do they have money on the bank account? Yes, they do. I think they have like 2 billion. Wait, let me see just to be sure. Yeah, $2 billion. Now, is the stock undervalued? No, it's not, because P/E ratio and intrinsic value are both overvalued. And is the stock price below 150 euros? No, it's not. Now, what would be the final decision, bro? In my opinion, you should not buy this stock. You should sell it because of the following. Even though they are extremely profitable, they have amazing dividend payments. This is like one of the greatest dividend stocks that you can buy, bro. Unfortunately, they have way too much debt. According to my a bit more in-depth analysis, bro, I will show you, they have, look, debt to equity ratio more than 200%, bro. That means that they have twice as much debt as they have the money coming in, as they have equity, okay? So this is way too much in my opinion, bro. I don't want to see that. They are also overvalued, both with P/E ratio and intrinsic value, and obviously they are expensive. Their price is higher than 150 euros. So because of the following things, bro, because of those three things, I don't want to invest in this stock, and I don't currently think that I will even be interested in it, because too much debt, overpriced, and overvalued. It's that simple, bro. I want to invest in cheap stocks that will bring me good dividends over the years and that have lower debt, because you can find companies that have lower debt, okay? I hate debt, bro, especially when it's a bad debt, so I don't want to see that at all, okay? Now, yet again, bro, if you want to learn the secrets to stock market analysts, then click the first link in the description. If you want to know more about stock market, bro, if you want to know more about stock evaluations, whatever, click subscribe, join me on this amazing journey to become rich with stock market, do the hard work, and see you on top of the world.